Sylvain Leduc is the Executive Vice President and Director of Economic Research at the Federal Reserve Bank of San Francisco. In his role, he oversees the development of key research and analysis to inform the monetary policy decision-making process. Prior to this, he served as Deputy Governor of the Bank of Canada, sharing responsibility for decisions on monetary policy and financial system sustainability. Leduc has also worked as a senior economist in the Division of International Finance at the Board of Governors at the Federal Reserve System in Washington, received his bachelor's and master's degree in economics from McGill University and doctorate in economics from the University of Rochester. We're so excited to have Sylvain here today. Welcome to Bend, Sylvain. I'll turn it over to you. We're super excited to hear what you have to say today.
Thank you. This is great. Thank you. I'm really delighted to be here. I meant to come to Bend for a while. I'm pretty outdoorsy, love like big spaces like this. Through the years, so I've been in San Francisco for about 15 years. Through all these years, many people have left. They've left the Bay Area. Many times they come to Bend. And I always wonder why. And now today I understand. You guys, you're really lucky to live in a beautiful region like this. And I'm happy to be here because, so I just mentioned, I'm pretty outdoorsy. I was surfing on Sunday. And I got a little bit of a surfing accident, a little bit banged up. But I went to see the doctor, and they gave me they cleared it for this trip. So I'm delighted to be here. What I want to talk about today is the progress we've made on inflation, and whether our policies have been able to rebalance the economy to something that's a little bit more sustainable. And at the same time, I'm going to show you some pockets of resistance that are keeping inflation high. And I'll discuss what that means for the outlook and for monetary policy. Okay, so I'm going to show you a fair amount of data. My job here is to kind of give this a narrative, and hopefully I can achieve that. But to start with, I think it's great to level set and see where like, the road travel over the past 2 years, because it's easy to lose sight of where we were and the progress we've made. So, maybe like you don't want to do this, but let's go back 2 years in the back. Let's go back to March 2022 and what it looked like in March 2022. And just as a bit of background, remember like we were coming out of the pandemic, of course. There was a lot of supply side disruptions, global chains were all impaired. It was hard to find workers, hard to find a car if you wanted to buy one. So inflation at the time was really high, 7% according to the PCE, the index we look at basically. It just basically surged. Prior to that, for the better part of 10 years, we always had problem getting inflation up to 2%. So the Fed has a dual mandate to start with, as you know. We aim for price stability, which we measure as 2% inflation. So low enough that it's not really the main factor impacting your decision making. And then the other mandate that we have is maximum employment. Try to get the economy in as much employment as we can, at the same time having price stability. So clearly, like I'm putting the red line here is the inflation target at 2%. Clearly, we were way above that in March 2022. At the same time, if you look at employment, like indicators of labor markets, here the unemployment rate, it was doing, by March 2022, was doing pretty well. So right before the pandemic, when you see the big jump in the unemployment rate as we were closing down the economy, the unemployment rate shot up to close to 15%, but right before that, unemployment rate was about 3.8, 3.9%, really historical lows that we were achieving at the time. By March 2022, we were back there. Okay, the labor market was doing very, very well. It's hard to think about that, but we had this huge disruption. But by March 2022, the Fed was basically looking at high inflation, but a labor market that was relatively strong. So in terms of policy, where were we at that time? Here I'm plotting two things. I'm plotting just the Fed funds rate, which is the policy tools that we manage to get the economy to the dual mandate that we're trying to achieve. And I'm putting the red line. The red line is called the neutral rate, basically the rate of interest where the economy is in balance, where we have price stability and we have maximum employment. So the red line is something we estimate. I didn't put error bands. If you put error bands around that thing, it's pretty wide. This is just a reference point, okay? So we know it's uncertain, but it just gives you a sense a little bit. So we estimate it to be about 2.5%. So clearly, during the pandemic, the Fed lowered rates to basically zero. We did quantitative easing, we bought assets. So clearly we're trying to, the stance of policy is really expansionary at that time. And we're facing high inflation and a labor market that's quite strong, so the Fed basically decides to raise rates. And so the stance became to tighten. We're raising, and then we continue. And the stance by now is above 5%. Rates are high. If you look at just the Fed funds rate, if you look at markets rate, longer term interest rate are higher often than that. And so you're getting policy to tighten relatively quickly by historical standards. So then the question is, what happened? What happened to our dual mandate? And so if you look at first what happened to inflation, well, inflation's pretty remarkable what happened over the past 2 years. So if you just look at inflation, it just went from 7% to less than 3% today. So it's quite remarkable to see so much progress in so little time. I think many people, many analysts that we were talking to were pretty skeptical that we would be bringing down inflation so quickly. And then on top of that, you have to ask, okay, so the inflation came down, what happened to labor markets? And this is where I think most people get surprised. So if you look at the figure I had right before, and then we extend it through time, the labor market remains solid and pretty resilient despite the big rise in interest rate that we engineer. So I think that's pretty surprising for many people. We were able to bring inflation back down, not to price stability yet, because we still have this gap between the inflation target. We're still above, closer to 3% than to 2%. But nonetheless, the rest of the economy is adjusted with minimal impact so far on the labor market. So I just mentioned inflation is still not at 2%. So what's keeping inflation high? So you've got the background, inflation has come down, labor markets have remained resilient. What's keeping inflation high at the moment? So now I'm just going to, you've seen the chart, I'm going to zoom in on what's happening a little bit more recently. And recently what we've seen since the start of the year is that the progress on inflation has been more bumpy. It's been slower than we've seen last year, for instance. And you see this if you check the two lines. So I've got two lines here. The blue line is headline inflation. It basically looks at all goods in the economy. It includes food and energy. Food and energy are very volatile, so often we remove those categories to focus on what we call core inflation, which is often a better indicator of where inflation is going to head in the future. So we look at both, but as a forecast, we often look at core inflation. It's a little bit more stable. So you see that since the start of the year, if you just look at the last data points, it's just been slower. The progress has been slower, even reverting for headline inflation compared to what we had last year. So this is what's giving pause a little bit to policymakers. We knew it wouldn't be linear progress throughout towards the red line, but it's been bumpier. So people are a little bit more concerned what's happening. Are we certain that we're on a path toward 2% inflation? So now I'm gonna dig into this. What's happening? Where are these pockets of resistance that we're seeing in inflation? And I think that the next graph is gonna tell you basically what's happening. So I'm gonna look at this measure of core inflation, and I'm gonna divide them between goods inflation and services inflation. So think about goods inflation, you buy a car, electronics, that type of thing. Think about services, you go to restaurants, you go get a haircut, those kinds of services. So clearly the blue line has been pretty dramatic. We had very high inflation in goods for a while, and it came all the way back down to where we were pre-pandemic. It's really important, this chart, because for the most part, between let's say 1995 to right before the pandemic, goods inflation was about zero. Basically had no inflation in goods. Part of it is driven by technological improvement that are high in this sector. Part of it is offshoring that are keeping costs low. So all these factors were contributing to having low inflation in goods. And for a while, it wasn't so clear if we would get back there, if we had such high inflation in goods prices. And now it's come back down. So that sector pretty much is doing okay. It's services. So everything is in services. This is where, and we knew that services are less sensitive to rate changes. You're not financing services by borrowing typically. And so we know it takes more time for rate increases to filter through the economy and moderate inflation in services. But basically, that's the main issue right now is in services. And I'm going to look at another chart to just disentangle this a little bit more, like dig into this a little bit more. And now I'm going to look at contribution to inflation from different sectors. And so you've got the boxes here, energy, food, and then these core goods and core services. And the core services I'm splitting in two things. I'm splitting into housing, so housing is part of services, and I'm going to look at all these other services ex-housing. Okay, so focus on the yellow and blues, and then you can see right from the get-go where we are right now. Everything in services. It's services basically the issue, and some of it is housing, and some of it is all the other services ex-housing. Okay, that's what we have to deal with. This is where there's so much focus, for instance, on housing. If we could get housing back to where we had before the pandemic in terms of contribution, you can see we're not quite there yet. That would be helpful, but also we need to work on services a little bit more. So if you think about energy and food prices, I know levels are high, but rate of change, that rate of change is what's important for contributing to inflation. And so this is not what's happening right now. In 2022, yes, energy inflation was high, food inflation was high, but less so now. And goods price inflation, if anything, is contributing negatively to inflation right now. So there's just another way to look at the data. It's really on the services side that the main issue is, and where we have more work to do to bring inflation back to 2%. So when you see this, you might wonder, okay, so the Fed raised rate, it's trying to rebalance. Chair Powell often mentioned this. We're trying to get a better balance between supply and demand in the economy, but inflation remains high. So is this working? Are the policies working? So let's ask the question, are we seeing a rebalancing and some cooling of growth in the economy so that we can bring inflation back down to 2%? I'm going to walk you a bunch of charts that will make the point yes. Okay, so first, I'm going to focus on the labor market. There's a bunch of indicators we can look at, but I like to look at this thing. I'm going to look at job opening rates, and I'm going to look at the quit rates. These are two important series, and you can see during the pandemic. So look at post-2020. You can see that these two series jump. I'm sure that in your businesses, you faced that. It was hard to attract workers. It was certainly hard to retain them for many businesses. You see the quit rates, the green line just going really, really high, and since then coming back down. So clearly the economy is cooling, it's more difficult to just job hop. It's just more challenging to do that. The number of openings has also come down. So for a while we had basically 2 jobs that were open for every worker that was unemployed and looking for work. So clearly the labor market was booming. Since then we've seen, you see this, the number of job openings, the rate of job openings has just come down quite dramatically. So the demand side is rebalancing to meet supply a little bit more. So this is like one sign that the economy is indeed rebalancing. And this is feeding into wages. So I'm sure you guys look at this all the time, a big part of your cost, wage increases. So this is one series. There's multiple series that you could look at. It's a little bit jumpy during the pandemic, ups and down. But if you look since then it's just this gradual decline in wage growth, from about 6% to 4% now. So I've put a dotted line here as a reference point. The dotted line shows it's a line at 3%. And I put this because that's the line for me that where you'd like to have wage growth on average over time to be consistent with price stability. So think of it as price stability, 2% inflation, and think about tagging on to that productivity growth. Okay, so you'd want workers on average over time to be compensated for inflation and for their rate of productivity. Productivity increases on average by about 1%, 1.2% per year. So if you think about these two, that you get 3%, so 2% inflation, 1% roughly speaking productivity growth. So you'd want wages to compensate for that on average over time to be consistent with price stability. And so you see that we're moving there. We're not quite there yet. There's still we could see a little bit more moderation in wage growth to be consistent with price stability if we don't see a boost in productivity. So if productivity were to increase, let's say to 1.5%, that could be sustaining higher rate of wage growth than we've seen in the past. Okay, so the other big piece of evidence here that things are changing is the number of gains in employment. So this is just showing you monthly, so the bars are monthly job gains, okay, like the payroll gains that you see on a monthly basis. It's pretty jumpy, particularly during the pandemic. You see these ups and downs, makes you dizzy. So we smooth it out. We look at the 6-month moving average to kind of get a better picture over time that removes some of the seasonality and the ups and downs of the data. You see that this has been moderating quite a bit over time. Particularly, like the last data point was reassuring. I'm sure you saw this in the press last week. For the numbers for April were much lower than we've seen. I mean, much lower than we've seen in the past. 175,000 new jobs being created. So, you know, again, kind of moderation on the demand side, which is what we're looking for towards numbers that are more sustainable. So, 175,000 new jobs is really strong by any standards. If you had been pre-pandemic and I tell you, you know, this is what we're creating in terms of job gains a month, you'd say we're in a strong economy, no doubt about that. And so the economy remains resilient. It's just that the pace of job growth is moderating. Okay, let me switch. So all these indicators, one thing that's important also is consumption. So let me switch to consumption to kind of show you what's happening there. And here, like what I'm showing is just the average consumption growth. The blue line is pre-pandemic, okay, 2015, 2019, just to give you a reference point. And the green line is what we've seen in terms of average consumption growth since 2003. Okay, so if you look at these two bars, you look at overall consumption growth, it's pretty stable compared to what we'd seen before the pandemic. And this is normal. I guess you can understand that. People have accumulated a lot of savings during the pandemic that is supporting growth, and I'll talk a little bit more about that at the end. And then, as I said, the labor market and wage growth has been fairly robust, and so that's kind of supporting consumption. But what you can see where the rates are having an impact is on durable goods consumption. That's quite a dramatic change. It's much more difficult to finance a car, electronics, and all that, and then you see this in the data. So again, you see adjustment of rates in the economy, and it's encouraging. I'll just close this section on the other part, and I find this chart to be just extraordinary in a sense. So this is detrended data. It shows real consumption, okay, compared to trend in goods and in services. It just shows the pandemic. It's just incredible. You see like goods prices. I mean, we're a services economy. During the pandemic, you saw consumption of goods just rising way above trend. The consumption of services just falling below trend. And so kind of disrupting the typical consumption patterns that we see in the economy. And now, since then, the economy has really normalized. So we see these consumption patterns coming back to what's normal. You know, less consumption of goods and more consumption of services, which is better because we're producing more services and we're producing goods just because we're a services-oriented economy, much more so than a manufacturing economy. So all this is just to say that the rates increases have had an impact. It's rebalancing the economy towards something that's more sustainable. So what does this mean for policy and the outlook? So, you know, we're seeing inflation coming down, but it's still, you know, there's still pockets of resistance. We're still not at 2% where policymaker would like it to be. We still see labor markets, the economy being resilient, but adjusting. So what does it mean for rates? So the Fed is publishing forecasts for projections for rates 4 times a year. The last time they did this is in March. I'm not going to show that because it's already stale. We're having a new projection in June. What I'm going to do instead is show you what market participants are expecting in terms of rates. And I'm going to do this at three points in time. Early this year in January, in March, and right now after the last FOMC meeting on May 2nd. And you can see quite a change in what people are expecting. So back in January, the market was basically expecting 5 to 6 rate cuts. You know, we were just coming out, like you saw the chart. Inflation was falling rapidly. The labor market was stable, so the market was saying, okay, the Fed is done, 6 rate cuts. By now, it's readjusting that perspective just because the data is coming in a little bit more uncertain. Inflation is bumpier than maybe like you'd want it to be. Policymakers a little bit more hesitant, also signaling that maybe rates are not, may not lower rates right away. So you see the adjustment. By now, the market is expecting about 1 rate cut by the end of the year. So it just gives you a sense of how uncertain the environment is at this point. Markets are really kind of in flux. They react quickly and they're sensitive to new data. What does it mean for the outlook? And here I'll just show the outlook from our group in San Francisco. So we think like we're on the right path. We think like this bump that we're seeing in inflation will work it through, and inflation is going to come back down. So just in terms of headline inflation, we should see inflation gradually come down to about 2% within 2 years. But by the end of next year, around a little bit higher than 2%, but really moving down. It takes time, again, because all of it is in services inflation. Services inflation are less sensitive to rate hikes, so it just takes time for this to be worked out. If you look at what it means for growth, kind of more the same, a little bit more moderate rates of growth than we've seen in the past, a little bit below 2%, but still healthy. And like same thing for the unemployment rate remaining around a little bit below 4%. So a pretty benign outlook if you want. Part of it is that the supply side, I've shown things on the demand side, but the supply side has been reacting fairly strongly. The labor force is growing. The labor force participation of women in particular has been pretty strong. Right now, for those between 25 and 54, really at an all-time high. So the labor market is on the supply side is reacting and it's helping making this adjustment possible. Okay, so this is just the modal outlook. As you all know, like you're all like looking at risk. Typically, I think this is how businesses are often thinking about the environment. What are the risks that I'm facing? How should I be preparing for what may come? So we do the same thing here. We think about risk all the time. We often think about policy as a risk management approach, trying to kind of set policy to mitigate the risk that we're facing. So just to start with, and I'm not sure, is this working? Okay, so this is a risk. We're trying to innovate all the time and try to get people a bit more engaged, but it doesn't work. So I was trying to ask you, what are the risks that you're seeing? And so I wanted to survey you and see what's on your mind. I have my own risk. We're trying to think about the economy, and we're seeing a bunch of risks out there. I wanted to point 2 of those, but I wanted to see if no? Okay, so Slido doesn't work. You can blame the firewalls of the Federal Reserve for that. So unfortunately, it doesn't work. Okay, so let's move on. So one risk that we're seeing is consumers. Okay, so I showed that consumption remains fairly strong compared to what we've seen right before the pandemic. But there are things that are changing. The first thing is the success savings that I showed. Okay, there's a lot on this chart. This is the personal savings rate. Right after, look at this, right after the pandemic, this is all that was accumulated in saving. About 2 trillion, I think I have 2.1 trillion that was accumulated in saving. There was so many transfers that were made, people and you couldn't consume, so people were just saving them for as rainy day funds, really. Since then, you've seen the decumulation of those savings. You see the areas now, that kind of pinkish area is even dwarfing the blue area. So these excess savings, according to our estimates, these are estimates, are basically gone. Okay, so people cannot rely on this for sure, not as much as in the past. So that's one thing that should be holding back consumption growth going forward. And the other one is the fact that consumers are falling behind a little bit more on loan payments. So if you look at these delinquency rate on consumer loans, this has been rising. It's still relatively low, but it's still been rising. So when you see these 2 factors, we want to take that into account. We think, as I said, the model forecast is still strong, but we have these risks. It could be that maybe we'll see a bigger slowdown in consumption growth. And that's why I wanted to survey you, like to see like if this is a worry for you also or not. The other thing, one concern is really inflation, and then maybe inflation has more momentum than we think. And this is something that's worrisome to me at the very least, and I'm sure to policymakers at large. So, okay, there's a lot on the chart. Let me like break it down for you. I broke down inflation into these core goods, and then these services, non-housing, core services, and housing. And I've got a bunch of charts here. I've got like inflation at the 12-month rate, 6 months rate, and then 3 months and 1 month. So basically, these are all annualized. So if I say like at the 1 month, let's pick 1 month here, get housing at 5.3%. It's basically assuming that the 1 month rate that we've seen, the last one, and I annualized it. And the annualized rate is 5.3%. So basically assuming that rate is going to continue for the rest of the year. So it's just an assumption. So we're basically annualizing the rate of change that we've seen either at 1 month, 3 months, or 6 months to an annual frequency. Okay? So let's just move through this. In terms of core goods, what we're seeing, you know, if you look at the change over 12 months, it's pretty good. You know, it's about the same thing that we've seen on average between 2016 2019, but recently we've seen pickup in goods price inflation. Okay, so that's one concern. Are we going to see this coming back down? You know, this is something to bear watching. In terms of housing, if you look at the 12-month change, any of those frequencies, 6 months, 3 months, 1 month, it just doesn't seem like we're making a whole lot of progress, right? We want to see more progress in there. That's another potential concern. And if you look at non-housing core services, then it's, you know, I'd say maybe a little bit more concerning, because when you look at lower frequency, the rate of change over 3 months, 1 month, it seems to be picking up. We want this to come down, not to pick up. So what we're wondering is this just a blip? You know, we know, I mentioned, it's not going to be a straight line down to 2%. It might be bumpy, but we have to assess this to see if it's going to move away, if it's just like special factors that are moving this, or if this is something that indicates greater momentum. So these are the risks that we're facing. But in terms of the modal outlook, we think that we're still on the path to 2% with growth that will remain relatively stable. So I'm going to stop here. I'd love to hear about, you know, if you have any questions, happy to answer. If you want to weigh in on what you perceive as the risk, since I couldn't survey you online, that would be great. Thank you.
Okay, so the 2% target number has always been out there, but there's very little explanation for all those of us in the cheap seats for why 2% is the number rather than 3 or 1 or pick any other percentage. So what is the 2% target? Yeah,
so many different factors about this. At one point, like the easiest thing to think about is that it's low enough that people, I think basically like low enough that it's not a main factor in your decision making, right? So that's, you could think of it too low. There's problem with too low, because then you can, if you're too low, you could get into deflation territory, and this is not associated with good performance. You could think about Japan. The Japanese economy often had deflation. It's not an economy that was performing very well. So often we wanted, I think policymakers at the time wanted to have a buffer, not too close to 0%. 2% was picked, you know, you could say 1.5, 2.5 might be fine, but 2% was picked as a reference point. At this point, the rate is chosen. So, you know, it's 2%. There's credibility in changing rates, to my mind, if you were to change the goalposts as you're trying to reach them. And next time around, when you have having credibility is really important for the Federal Reserve, because it allows us to do more when there's a recession, because longer term rates don't move as much in a sense because they're anchored by the 2% target. And so if we were to play with this, it introduces the risk that next time around, financial market participants are thinking, well, you know, you moved it to 3% this time, so maybe you'll move it to 3.5%, and that gets reflected in higher interest rate when we may be wanting to lower them. So this is why I think like keeping the 2% target is really important in terms of credibility. And, you know, we've made a lot of progress already, so, you know, we're getting there. Yeah.
So, I got two questions for you. One on the household. You mentioned that's been a lot of headwinds in there, and record high part of the inflation. How much of the forced minimum wage increase is playing into that?
Well, the minimum wage increase in some markets, I'm sure, you know, if you think about those that have implemented these, is supporting some consumption. I don't think that's the main driver here, because you can see even with that, like the rate of change in hourly earnings is coming back down. So I think it's at times factoring in, because again, you have to think in terms of rate of change. So level versus rate of change. When an area or a city introduces a minimum wage increase, then it gets factored into inflation and increases in wage rates. But after that, it's constant, and that doesn't get factored in over time. So that's kind of the problem. Really, you know, in terms of level, yes, it's supporting the economy and consumption, but in terms of rate of change, less so.
And then the second follow-up one on the consumer consumption. You mentioned that you're starting to see some headwinds. You talked about the reduction in savings, increase in loan default. One thing I didn't see here was the level of credit card debt.
Level. So in terms of, yeah, okay, so I don't have the number about levels of credit card debt. I think on average, if you look at, so the Fed is publishing a financial stability report. Consumers, household in general, are in much better shape. The balance sheet are much healthier than they were, let's say, around 2010, 2008. Level of indebtedness on average is much lower. A lot of it is, you know, the indebtedness often is associated with housing. This has been much lower, so I don't remember exactly on credit card debt, but anyway, in terms of delinquencies, there's something we're watching for sure.
Aaron, do we have any questions from online?
I don't.
Wendy?
You mentioned that women ages 25 and 54 are at all-time high employment.
In participation rate.
So what are the factors that you guys think are contributing to that, statistic? You know,
I think one of them might be remote work, as a matter of fact. It makes it much easier to get attached to the workforce. I mean, often women are bearing the brunt, let's be frank, of child rearing. And so that, I think that kind of flexibility for many industries, if you work in tech or like some of these industries, allows you to work from home, having maybe a slightly more balanced work-life balance. So I think that's clearly that's a factor that I think is helping out. We might not have thought about this early on, but I think it does. It's quite remarkable because after the pandemic, labor force participation of women and men, but particularly women, really cratered. And once you leave the workforce, it's never clear if people are coming back. And so that's the fact that you can do this a bit more flexibly, I think, is one factor. And also, the labor market has been strong, and typically when we see these cyclical recovery, it pulls people back in. So I think these two factors, why women, I think the remote work is one factor to think about. Yeah.
I wanted to ask about the connection between workforce and services inflation. I mean, you've talked today about, there's still a lot more openings than quits. Unemployment levels are at still pretty low levels. I mean, at the local level, I can point to employers all over our community that could be producing more services if they had if they were able to find more workers. So, I mean, are those two things pretty closely related, workforce scarcity and services inflation?
Okay, so I think in terms of the supply, the labor force participation has really been strong, stronger than we would have thought. And on top of that, immigration has been a huge factor. The CBO came up with these new estimates of how much more immigration we have than was factored in. that's another impact. So I think like what we're seeing, like the demand, it's really the demand side is coming back in better alignment with a growing supply. So depending on markets, that may play out very differently. So if you're in Bend, Oregon, maybe the area is growing so fast that maybe like supply is not catching with demand. Other places, less so. So I think like the adjustment is not complete, but clearly things are moving in way better balance.
Will that lead to services inflation?
Yeah, so I think like the way to think about it is like on the demand side, these higher rates are percolating through the economy, are slowing things. It takes time to impact services, but it does over time. So like you get the demand side weighing on consumption of services. On the supply side, you see like a greater supply. A lot of it, like for instance, like on the immigrant side, will probably work in construction, on the services industry. So you see the supply side increasing at the same time as you see demand kind of moderating. And so these two factors over time should bring inflation back down to level consistent with 2%.
I mean, one of the alarming statistics that someone shared with me recently was we've got baby boomers retiring at 10,000 per day out of the economy, and how do we replace that workforce?
Right.
Birth rates in the last 20 years have not been very high.
Yeah. So behind all this, there are like these big structural shifts in the economy, and those are kind of long-term trends that we've known have been there for a while. So we know, labor force overall is kind of on a declining trend, but there's a cyclical aspect to this also. And the cyclical recovery has been stronger over the past 10 years. I mean, often like you see charts where you thought women's labor force participation is a great example of this. Even after the Great Recession, people thought, women's labor force participation had declined, and then it's just the trend, aging that's going to take over, and we're not going to see a pickup. We've seen huge pickup at the time. Between 2015, 2019, women's labor force participation came back so strongly. And we're seeing this again this time. So, it's encouraging, I would say, given the trend, given what you're saying. In the background, you have aging that's reducing the workforce. But at the same time, you're seeing big recovery that are cyclical, that are pushing against that, offsetting some of that. Yes?
So thank you for this presentation. It's a lot of good information. And one of the things about our community, and I'm going to pick up on your theme a little bit, Phil, is just there are so many big factors that are influencing the economy that a region like this has a little more brittleness in terms of its reaction to the larger forces. So one of the things that I would note in healthcare, we at St. Charles are a mission-driven organization that needs to be here for the next 100 years, as we have in the prior 100 years. And we are subject to the very cyclical changes. One of the things that's manifesting in our institution and institutions across the state and the country is that the number of highly skilled and educated workers and physicians, that is plummeting because of retirements and a lot of the impact from the pandemic. That is leading to, I think, a significant contribution to the services inflation, because we're now competing nationwide and in some cases internationally for very specific services. That's a challenge that we have in the context of a region that has to be able to fund itself. And that seems an unfair situation, but it is what it is. So that's one significant change that's happened post-pandemic. We also have debt levels that are higher than we've ever seen. If you accumulate all of them, whether it's credit card debt, the national debt, at some point, how is that factored into what's going on in your predictions for the future? And that change of excess savings, I think, is kind of that inflection point that suggests that something's going to give, because people can't spend at the same level as they have been. So how are we going to navigate this excessive amount of debt and some of these huge factors in a region like Central Oregon, where we don't have the commercial base and diversification of other areas. That's a big concern for us.
Right. So I'm sympathetic to that, right? I mean, particularly in a region like this, where, as you mentioned, you're less diversified, maybe a bit more subject to the whims of a particular industry. So there's little that we can do for that, clearly. In terms of that, I think the main issue is really at the national level more than, as I mentioned, for the household. It's surprising. When you look at the numbers, you know, at the aggregate level for household indebtedness, it's really come down. It's less problematic than it was 10 years ago. There's been a lot of work done on this just in terms of like how you can get indebted to buy a house. So it's difficult. It's much more difficult to buy a house today than it was in the past. And in part of it, it was like try to put guardrails on the housing sector and level of indebtedness. At the national level, it's a different story, right? We know like the level of debt that we have right now are unsustainable. If you look at pretty much any analysis, the Congressional Budget Office, for sure, policy will have to adjust at one point. And this is waiting on rates, for instance. For the CBO, it's really not bullish on, they're not seeing lower rates for the foreseeable future just because of the amount of indebtedness that needs to be financed is pushing rates higher in their views and in the projections. So you have interest rates in the long run at 4% nominal 10-year rate, which is really high compared to what we had before. So they may not be right, but that's maybe one factor that could weigh in on growth in the future. And of course, from those projections, what's kind of concerning is that the share of the budget that goes into the service payment, interest service payment, is really growing fast over time. And so that's concerning for sure, but that's just unsustainable. And I think people have been saying this for the better part of 20 years. At one point, an adjustment will need to be made, either in terms of taxation or in terms of government services. I mean, these are the levers that will need to be adjusted.
And your projections currently don't assume anything with respect to that, because that's just such a massive change that hard to know where the politics will lead that to.
Exactly. So the CBO, for instance, does this assuming policy is constant. They don't play with policy too much. And we could speculate, but our value add, our comparative advantage is not so much in predicting 20 years down the road. We try to get the economy right maybe for the next 2-3 years. If we can do that, given the uncertainty, that's pretty good. Yeah.
So I've scratched my head for a long time on the measurement of the housing inflation. How is that measured? Because I'm in the commercial real estate business and with a focus on multifamily, and I look at multifamily nationally, and I can tell you 2003 and year to date, rents are flat to negative. Mm-hmm. The value of multifamily housing is taking a big hit. It's 10% down or 20%. And I really don't think single family housing has gone up. So I'm scratching my head at how that is measured.
Okay, so I had a chart on this. I pulled it out, but maybe incorrectly. So, it is tricky. Like the way the BLS is, the Bureau of Labor Statistics, is looking at that, is looking at average rents in the economy. So some of the rents, if you're a renter and your rent is not moving that month, then it's basically flat. And then some other people are renewing their lease, and then the BLS picks up what you're mentioning, the fact that rents are either moving down compared to where they were before. But it takes time for those new rents to be reflected in the index. And so that's what we're waiting for. That's why we're kind of optimistic that housing inflation is going to come back down, because we see the market rents, the same thing that you're seeing, having declining a lot, or being moving more flat, being flatter than the index, the overall index is. And so the measurement is tricky. Like you have to look at rents. But if you own your house, for instance, the BLS is also thinking about something like owner equivalent rent. So if you were to rent your house, how much would that fetch? That's not an easy measurement, because you need to find comparables. So just to say that it's not an easy area to be in. I'm glad we don't have to do this at the Fed, but that's also why we think that housing price inflation is going to come back down, because of what we see in market rents, particularly in multifamily housing.
I think we have time for one more. I'm going to close it out
He's
with
like
this,
he's
if I
saying,
may.
and the last one's always the most difficult. Pick wisely.
I'll try not to make it so. First, again, thank you. I love the fact that, you know, you're a surfer. I can't imagine a conversation on the surfboard when someone asks you what you do, right?
Yes,
You do what?
that would be like a
That's
conversation
great.
killer.
So the question I have is, you know, a lot of this inflation is tied to federal stimulus, right? There's more money for people to spend, including government agencies, which drives goods and so forth as well. And because of that sort of being artificial, how much of this decline is that money running out? And how do you take that into account when you start making decisions that it is potentially artificial?
Okay, let me broaden this a little bit. That's certainly one factor. We've done work on this. You know, the amount of transfer we're contributing to inflation, particularly if you compare early on to the rest of the world. Like the US did way more in terms of transfer than other countries have done. But you know, that's not the only policy. Monetary policy is, at the end of the day, a driver of inflation. We've kept rates low for a long time. We had, you know, asset purchases, so I don't want to put all the burden on fiscal policy. Supply chain disruption were a big deal. You know, that's a big contributor also of the inflation we've seen. So there are many different channels that were active at the time. I think like that one in terms of fiscal policy is disappearing. Monetary policy is tightening also. So all those channels are contributing to getting less inflation. Monetary policy with higher rates, fiscal policy because all the stimulus is running out and no new one is being added. And the supply chains are being repaired. So all of these are working in tandem in a sense to bring inflation back down. For us, it's just a matter of like having the right policy to making sure we're coming back down to 2% in time with the minimal impact on the economy.
Terrific.
Well, thank you so much. It is really important for us to do this. Like I'm visiting Ben today. You know, we're in San Francisco looking at the numbers on screens, but coming in on the ground and talking to you about what you're facing in terms of economic environment is really priceless. So thanks for having us.
Thank you.